Again, the 401k being the defined contribution plan, you're limited. And I believe that 2025 amounts are 70,000 total. That's with the employer and employee contribution for a 401k. I believe it's the same for a SEP right now. Whereas, with the defined benefit or cash balance plan, you're talking about significantly more. Generally speaking, our clients are contributing in excess of $100,000.
Hey, we're back. Paul Martin, thanks for being here with us. Paul is CEO of Eagles Coast Capital and Eagles Coast Wealth Management. Working with Paul now for going on 5 years. Paul, actually, his firm manages all of my investments, retirement products, and most, if not all of 1099 Tax Doctor's clients. So thanks for joining us. Paul, give us a little bit of your background.
Yeah, sure. Thanks for having me, Eric. I was fortunate to start my career with Morgan Stanley in New York. Worked for Morgan Stanley Global Wealth Management for a number of years. Managed a number of different benefit plans and retirement plans while I was there. Ultimately left and started my own RIA. And we've been running this business now for well over 8 years, independently. And in doing so, we've had the good fortune to work with a number of different folks, literally hundreds and hundreds of individuals, in need of retirement planning. As a result of that, I believe that's how we ended up meeting up and connecting with 1099 Tax Doctor. And we've been fortunate enough to carry on these services for a lot of the good folks at 1099 Tax Doctor. So
we certainly appreciate it. But so today we're going to be talking about some retirement products, retirement plans. Specifically, one thing that we get the most questions about are defined benefit plans, also known as a variant of cash balance plans. And they're very mysterious to a lot of us docs who are not in this world. So maybe we could start out if you would just tell us a little bit about what is a defined benefit plan? What do you do with it? How does it work?
Yeah, so ultimately, when you think of these plans, there's really defined benefit plans and defined contribution plans. And I think most people are familiar with the latter, the 401k plan, which is a defined contribution plan. And really, the defined contribution plan is specifying the maximum amount you can contribute up front, whereas the defined benefit plan aims to generate a benefit upon retirement. And the cash balance plan falls underneath the defined benefit plan. And then the real benefit there being with a cash balance plan, the individual is able to contribute significantly more money to a cash balance plan and therefore mitigate those top line tax exposures that they have. Gotcha.
And as I understand it, the defined benefit plan, it's a pension plan, right?
That's correct. Yeah. So traditionally it's created and set up so that you'd have an annuity upon retirement. But I don't like to confuse people and say, annuity in the sense that it's an insurance product or anything like that. It was originally created to create a pension plan, which is essentially annuitized over your retirement. In the case of a cash balance plan, though, when the plan is finished or terminated or it's reached maturity, that plan can be then rolled over into an IRA plan, and ultimately you can use it in a lump sum, and it doesn't have to be annuitized in that way.
Right. And didn't that change happen because of all these municipalities, years ago that were going bankrupt because as life expectancy goes up, the cost of companies providing an annuitized pension was really high. And so the tax law was adjusted to allow for this kind of cash balance plan subset.
Sure. Yeah, so you've had incredible amounts of shortfall with pension plans that were managed incorrectly. Famously, I think you had some major companies as well that did that, and they modified their pension plans as well. So you're absolutely right. That's the reason why they modified the plan.
Yep. Thanks. So what kind of people would use a defined benefit cash balance plan?
So really, you're talking about very successful small business owners. I think they do the best with, your cash balance plan. I know traditionally the 1099 tax doctor clients are individuals or individuals with their spouses contributing to these plans. And really, it's just kind of a booster for retirement. So if you're a high income earning individual or professional, and you want to really supercharge your retirement and you want to mitigate your tax exposure, these plans are perfect for that. And then really, for people who feel that they may be behind in contributing to their retirement, individuals, in their 50s and 60s, they really, really benefit from these plans because they're able to kind of catch up quickly to contribute to their retirement.
Right. The older you are, the more money you can contribute to the plan.
Absolutely. That's right. Basically, they utilize an actuarial computation, and that generally takes into account the amount of income you make, and your age greatly affects that. So the older you are, absolutely, the more you can contribute to it.
And of course, the main benefit to these plans is basically you can put a lot more into them than a 401k or a SEP IRA.
Significantly more. So again, the 401k being the defined contribution plan, you're limited. And I believe the 2025 amounts are $70,000 total. That's with the employer and employee contribution for a 401k. I believe it's the same for a SEP right now. Whereas, with the defined benefit or cash balance plan, you're talking about significantly more. Generally speaking, our clients are contributing in excess of $100,000. And then oftentimes they're combining that plan with a 401k plan as well.
Right.
So they're really kind of supercharging their retirement contributions.
Right. Yeah, that's actually what I'm doing this year.
Well done.
So what are some things someone should consider if they're self-employed or they're 1099 and they're considering getting a defined benefit plan? What are some things they should consider, some pitfalls they should avoid?
Yeah, so realistically, there is a commitment, right? The IRS doesn't look at this as a one-time tax haven. So if you're going to consider utilizing a cash balance plan, you should be in it, for, the next few years at a minimum. And you should consider that the source of income, however it's coming in, is going to be consistent for that number of years to allow you to contribute to the plan. You don't want to open up this plan for 1 year and then find that your income changes and you have to close it right away. So I think, that's the major consideration, I think, that people need to look out for.
Gotcha. Okay. But what about walk me through the process of how you, who do you get a defined benefit or a cash balance plan from? Walk me through the process of where do I go to get that? How do I set it up, and what is that process like?
Yeah, so you really want to utilize a good TPA, third party administrator, and that group should be seasoned. They should definitely have some experience in the industry. Those people are going to sit down with you and discuss what your goals are, what it is that you're looking to do. And they're going to create the plan document for you, right? So that's the first, covenant, if you will, or that's the first, step in implementing the defined benefit plan or cash balance plan. With that and within that plan, they'll include requirements such as 1,000 hours of work, within that company. They'll determine ages. They'll determine crediting amounts. The crediting amount is basically it's a percentage that the plan should return annually, and it's a commitment by the employer. In our case, we're talking about the individual. It's a commitment that plan will return a certain percentage annually. And that's usually a conservative return, somewhere around 5 and 6%. And so that's basically created so that the capital will be there no matter what to ensure that person has that full retirement. And so you put those plans together. We work with those individuals. And it takes usually about a week for us to do that.
Let's go into, if you wanted to go get a defined benefit plan somewhere, who do you go to? Where do you buy them from? What's the process look like?
Yeah, I think you got to screen, the people and consider who it is that you're using for the service. You should look for TPAs that have some experience and have been around for a number of years. a big part of that is, making sure that they work with actuaries. The actuaries are a big component of your cash balance plan. They're going to put together the actuarial computation. They're going to oversee the plan at a minimum of once a year. They're going to review your Schedule SB and sign off on that. So really important that those people have an actuary on staff, or they're using actuaries. And those are enrolled actuaries. Ultimately, we personally will sit down or we'll speak to clients and discuss with them whether or not the plan's right for them, make sure that they're in it for the long haul. Mm-hmm. And then, we also determine, would you potentially borrow from this plan? Would you ever roll the plan over? Would you ever need an in-service withdrawal? These are all things that come into play when you actually create the plan document itself. Mm-hmm. And the plan document generally governs how you're able to invest, how the money might be distributed, what might happen in the event that someone passes away, who the trustees and the administrators are. So there's a number of considerations, mm-hmm. But ultimately when we sit down and we talk to an individual who's going to do this, they should have a pretty meaningful conversation with whoever the third party administrator is before they get rolling.
Are there bad cash balance plans out there, badly written plans?
There definitely are. So we have certainly come across individuals that have poorly written plan documents, and then we have to basically look at them, edit them, and restate them. And it does take a little bit of time, but it is important to get that done right up front, so that you don't have those issues, on the back end.
Mm-hmm. So as I understand it, you have to fund these plans every year, right? So you're kind of making that commitment you had mentioned. What happens if, let's say, you don't have any business income the next year, or you get disabled, or you can't work, or for whatever reason, you can't fund the plan? What do you do then?
Yeah, I mean, there's a number of issues that could happen if you can't contribute to a plan, and it happens. You really have to have a good relationship with your third party administrator, and you have to speak to them. So if you anticipate that you're not going to be receiving the income in the same way, or you're not going to be able to fund the plan, you need to get with them sooner than later, because there are underfunding penalties. There is an excise tax that the IRS will charge, which is 10% of the minimum contribution amount. Let me just back up for a second. You will have a minimum and a maximum amount that you would contribute to the plan on an annual basis. And so if you don't fund that plan without cause and you're too late to rectify that issue, you will have to pay that excise tax. But if you have a good relationship and you have a good TPA, you can kind of work through these issues. And some of the reasons or the ways that you might be able to do that is determine whether or not you reach the 1,000 hour minimum threshold that's written in the plan document. And there's a couple of other ways that you might be able to pause contributions, mm-hmm. but you have to do it in a timely fashion, right? Because the clock's always ticking with when you're going to file your taxes and when the plan needs to be funded by.
Mm-hmm. Yeah, makes sense. So let's say you set up your cash balance plan. Tell me about how you ought to invest that, and when you should, employ the services of a third-party money manager or a wealth manager to direct the investments, and how that works.
Yeah, so primarily we work hand in hand as a wealth advisor for these individuals that open up these plans. And, I think what we do is we help maintain what that crediting rate is so that you don't have great fluctuation in the return on the plan, and you don't have a great impact on what the contributions or amount are year over year. We certainly get questions from individuals saying, well, the S&P might have been up 25%. Why did we only return 7%? Well, we're keeping in line with that interest crediting rate and making sure that you don't have these incredible fluctuations. Conversely, we're doing our best to make sure you don't lose money in the plan, which would then require a larger contribution amount in the subsequent year. So that's our responsibility as a financial advisor and wealth manager. And then we tend to keep an open line of communication and dialogue with your CPA and your third party administrator, which we work with closely, to ensure that everything is compliant and that you're not missing contributions and that we're recording these things so that, everything is concise and on point.
Great. So what you're telling me is I probably shouldn't go all in on NVIDIA in my cash balance plan.
You might have some difficulties. I'll tell you, I don't think the actuary would be too happy with you if that happened.
All right. So yeah, Paul, you had mentioned earlier about combining a cash balance plan and a 401k. Can you tell us more about how you do that?
Yeah, certainly. So, obviously we spoke about how a cash balance plan is significantly helping people to maximize their retirement contribution. The beauty of the cash balance plan is we can pair that with a 401k plan. And there's certain restrictions with that. So that individual, so they will focus on contributing to the cash balance plan first, and maxing that out as much as possible. But then with that, they can continue on with their employee contribution, which at this point is in 2025, $23,500. And then they'll be able to do the employer contribution, which would ultimately be 6% of their income.
Gotcha. Okay.
So yeah, it makes for a pretty compelling case to do both together if you can do it.
If you can.
And going back to what we spoke about in terms of bringing people on and speaking to them and determining whether or not this is right for them, obviously another big part of that is when you're making $500,000 or more, you have to determine, can I in fact contribute $100,000 to a defined benefit plan or a cash balance plan, and it becomes a quality of life issue. What is important to you? You need to determine, am I going to make any big purchases? Is there consideration for my children? Am I going to buy a rental home? And so those are the kinds of questions we ask people to make sure, hey, look, before we get into this, if we're talking about contributing, six figures to something, just be certain you don't have any other unexpected costs or things that, that take priority over that. But yeah, when you really want to supercharge your retirement, you can absolutely combine the 401k with the cash balance plan.
Yeah. And I understand some of the 401ks, you can actually make a voluntary Roth contribution over and above the tax deferred portion, right?
You absolutely can. So, straying a little bit away from the focus on the cash balance plan, for a 401k plan, you can make an increased contribution to that 401k plan, over contribute, and then you contribute that excess capital to a Roth 401k. You just have to make sure that your 401k documents are written in such a way that it allows for it as well. Right. And then that would be considered an in-service withdrawal and contribution to the Roth 401k.
Right. Great. So what do you think about when you're counseling someone about a cash balance plan? Do you take into account like outside investments, other investments, and things of that nature?
Yeah, we absolutely do. Primarily because we don't want there to be a redundancy for that individual. So, generally speaking, when we're investing plan assets specifically for cash balance plans, again, trying to achieve that crediting rate, we're looking at investing in, low cost ETFs, some fixed income, some structured notes, but anything that's giving us kind of a very low vol return. Okay. But if someone outside of that has investments in similar strategies, we want them to know, hey, look, this is what we're doing. We don't want you to have this redundancy in your outside, investments and your outside plans. So it's important to kind of know what they're doing. And we call that KYC, know your client here in the industry, and make sure that, you're doing your due diligence on the client. And obviously we have a lot of incoming inquiries about financial planning, things of that nature. And then, that's a whole other conversation and consideration that we have for those clients.
Sure. What are some of the biggest mistakes you see people making when they're using a cash balance plan?
I think it's the beginning. It's understanding what they're getting into, understanding that it is a commitment. As I mentioned before, sometimes it sounds like a great idea, but then, when you're reaching back for, potentially, that extra $50,000 or $100,000, and you're committing that to a retirement plan, that can be difficult for some individuals. That might change their quality of life. So you have to go into this with open eyes. And so I find that that's kind of the biggest mistake that people make is they don't really totally understand what they're getting into and what the commitment is.
Gotcha. Yeah. I mean, it makes total sense. I've been, preaching this to medical residents that get out of residency, and they're right away, they take a 1099 job, making, multiple six figures, doing really well, early 30s. And it's like, if you can just get a cash balance plan, put $100K per year towards it. And because of the tax savings, it's going to cost you about $65K per year to make that contribution. But you do that for 10 years with the steady rate of return. And now you're in your early 40s with 1.4, 1.5 million with compound interest in the bank, not subject to capital gains. And then that's in a very good spot to be, because between early 40s and age 59, let's say you want to fully retire at 59, you cannot even put another penny towards retirement after your early 40s. Cut back on shifts in your 40s and 50s. Don't have to worry about it because compound interest is doing the heavy lifting. And then around the time you're 59, guess what? You've got about 6 million with a low conservative market rate of return. And all it took was 10 years working as a physician, just contributing to this plan that gets invested in the market. It doesn't require, complex real estate investments. It doesn't require building up a portfolio of short-term rentals in a market which isn't great for that right now. It doesn't require getting real estate professional status. It doesn't require you doing anything other than just mindlessly putting money into a retirement plan that just gets invested reliably into the market. And you just do what you do. You be a doctor. You just practice medicine.
There's no question.
You spend 11 years, 12 years, 15 years learning how to do that. You do that, and this is really easy. And all it takes is 10 years, bam, retirement's done.
Eric, if people took your sage advice, they'd be a lot better off. There's so many other things, and there's so many other things pulling in people's attention.
Yep.
And you're right. Your greatest focus could be on what makes you the most amount of money, which is your profession. Mm-hmm. And doing this should help you sleep at night a little bit easier.
Mm-hmm. Yeah. And I see so many docs that get into their 40s and 50s and they're behind. They're behind on retirement, behind on savings, because you want the house and maybe the vacation home and a nice car, and like all those things are great. But it can a lot of those things can also kind of get you behind the 8 ball, and compound interest is just your best friend. And just the earlier you can, take advantage of it, like the more leverage you have.
No question. And I'll say this, just because you asked what some of the pitfalls are, not working with the right professionals. Mm-hmm. You see that a lot. People get pulled in a lot of different directions. This requires coordination between your TPA. It requires coordination between your TPA, your CPA, your financial advisor. You have to get all those people coordinated. And I'd say I applaud you on putting this together, where people have that all in one place. Because, obviously we work with a number of different groups. We work with financial advisors. We work with CPAs, all separate from one another. Mm-hmm. And we see the confusion. We see the miscommunication a lot. So applaud you for putting this together.
Yeah, appreciate it. Yeah. Absolutely. That, when I first was setting up my cash balance plan, this was actually before I had met you guys years ago. And I had a TPA quote me, I think about $6,000 to start to set up a plan. The manager I was looking to work with was charging 1.5% AUM to manage it with a $2,500 initial setup fee. And I've run across, many clients that had a very similar experience of just, you don't know what the market rate is. Mm-hmm. And so it's very easy to get taken advantage of and pay well in excess of kind of what you ought to be paying, is, what it really costs to be able to provide these plans.
The market's so fragmented and there's so much information out there, and it's either somewhat esoteric and difficult to understand and comprehend, or it's too much, and you don't know what's right and what's wrong. And by the way, for your retirement assets, you definitely shouldn't be paying those kinds of fees. That's way over market for anyone who's listening.
Yeah. All right, Paul. Well, let's call it a day, but thanks for stopping in with us and appreciate you taking the time to talk to me.
My pleasure. I appreciate you having me. Thanks.
All right. Bye-bye.
You've been listening to the 1099 Tax Doctor podcast. Dr. Eric Wright isn't just talking about 1099 income, he lives it. As a physician and independent contractor, he's learned how to make the tax system work for him and for his colleagues. Learn more about how Dr. Eric Wright helps physicians keep more of their hard-earned income by visiting 1099taxdoctor.com. This podcast is educational only and not personalized tax, legal, or financial advice. We're here to talk strategy, not write prescriptions. Always consult your own licensed professional before making decisions about your own financial situation.